Well, good evening. I'm looking forward to talking about early stage investing right now, and I want to make this very informal too. So if there's questions as we go along, please interrupt, wave, and we'll talk about it, because Pira started saying this is a networking event. Well, to some degree, angel investing is a networking event with money. So we are going to just talk about angel investing and why it's sort of an innovation engine for different economies. I'm going to talk a little bit from the national perspective, from the ACA, which talks about the number of angel investors in the United States and their reach, a little bit about JumpStart, and then also too about some of the ancillary activities in the early stage funding space, like crowdfunding, both equity and non-equity crowdfunding, and glad to answer any questions. The Angel Capital Association represents something in the order of 200 plus members throughout the United States, 8,000 or 9,000 accredited investors, and affiliated organizations like economic development organizations. And they also have a research group which does research on angel investing and its impact. The 200 groups throughout the nation are all different. Some of them invest locally, some of them invest nationally, some of them are very focused on a certain area of investment. And I'll talk a little bit more about the types of angel investors. An angel investor, and we're going to talk about groups first, because groups are really the most powerful point of angel investing. They invest more dollars, they give focused assistance to early stage companies, and they're more powerful in the way they aid companies to grow. There are individual angels, talk briefly about them. There are groups that have other models, but the angels and groups really deliver a lot more. A lot of the groups have been around 8 to 10 years, although there are lots of angel groups forming now. Big increase in angel groups. They'll do an average of 10 investments. They might have 2 that have exited or closed, and the risk is very high in angel investing. So you expect more than half of your investments to fail. How about that for a model of a business? The average member might have 14, 15 years as entrepreneur. A lot of members are cash-out entrepreneur, as like Mario, where they sold their business to another company. A lot of them are C-level executives at large corporations. They themselves may have founded a couple of companies, the individual angel investor. Age is 57, because it's after someone does this exit, after they've done a few companies, that they say, you know, I like this space, but I'm just not doing it myself directly anymore. I want to invest in smart people who are doing it. And it is a risky space, so angels invest, you know, hardly more than 10% of their wealth in this area. The JumpStart fits very much in the same profile. The group started investing 10 years ago. It had 12 members to start with. It says our current number of members is actually closer to 48 these days. We've done more than 50 investments in multiple rounds, because you follow on your rounds of investments. And our investment preference is somewhere between $200,000 and $1 million in a first round, which sounds like a lot, but in our group, people are investing. You can have a deal with one JumpStart member investing $50,000 or $25,000. Total investment to date is actually, this number's gone up. It's closer to 50 some odd million. Excuse me, 48 is a good number. And exits and closures have been about 15. And we also are interested in funding alternative forms of early stage investment. And one of the things that we've funded has been the Tech Launch Accelerator that Mario has started. So funding and starting early stage startups as a group and training them. We've also invested in a crowdfunding platform too. So the depth and breadth of angel investment interests within JumpStart are very wide. So the topic of this is sort of like the innovation funders for angels. Angels start at the seed level, and nationwide there's about 800 new companies a year funded by the ACA angel groups. They have more than 5,000 in their portfolio, on the board of directors as an observer if they have enough of an investment in a company, but they see 75,000 companies. So less than 10% of those companies that are out there get angel funding, and a smaller number than that get VC funding, because people always sometimes lump VC and angels together in the same sort of basket, but angels are much earlier, before a company is really truly, it's a seed stage. And the exits are really, if you're successful in this early stage, you have an exit, which is generally a merger and acquisition, an acquisition by a larger company. The dream of an IPO is certainly every investor's dream, but it doesn't happen that often. The current issues in the early stage investment area is syndication rounds with other angel groups. Several years in the past, the VCs really fled from the seed stage, and they're not in that space anymore. So a company that needs $1 million or $2 million, the only place they can get it these days is if angel groups band together and can generate that kind of investment. Otherwise, the VCs aren't there. So you can take a very robust company, especially in these days when you're doing early stage technology platforms in the cloud, and you can take it to profitability or take it to cash flow break even with only angel investment. There's also crowdfunding impacts and opportunities, and I'll talk about that a little bit later on. And there's an increase in angel investors into groups, people who want to self-direct their own investments or know something about a space that they really want to concentrate in. There's also a need for angel investor education. Right now, with the recent Jobs Act, there's been a lot of changes to this early stage space, all of which are not finalized yet, and we're still waiting for some SEC changes which will affect the general investing investors in the crowdfunding space to a large degree, as well as angel investors. So there's all types of angel investors. There's friends and family. These are the people who love you, who give you money. They have no idea what you're doing, okay? And the only thing we say to early stage investors is make sure you treat these early stage investors well, that you don't say, Mom and Dad, I've got a $10 million business right here, you can buy 10% of it. And then, 6 months or 9 months later on, when you realize you have a $1 million business and you have to have your parents take a haircut, that's a bad place to be involved with your parents in that space. But they love you, but they're investing because they love you. They have no idea what your business is about. There's also individual angels. There are some angels. There's two types. There's like a super angel who's really like a small venture fund. There's also lone wolf angels who sort of like to do their investing by themselves. And some of these individual angels are very sophisticated, and some of them are not. So an early stage company has to be able to determine what's going on there. Right now there's crowdfunding, and for those of you who haven't been familiar with this area, what it is there are platforms now which are available only to accredited investors. And accredited investors is an SEC term of art. It says you have to, as an individual, earn $200,000 a year, or $300,000 as a couple, or have $1 million in net assets excluding your primary residence. And all that is a test that says you can afford to lose money. That's literally the test. So if you can't afford to lose money, the SEC doesn't want you to be in early stage investing or see business plans. And so you have to be an accredited investor to be able to be shown business plans by companies. So in crowdfunding, there are crowdfunding platforms right now for accredited angels for equity investments. And we'll talk about that a little bit later. There are proposed platforms for what I'm calling the general investor, which the SEC has not yet finalized the requirements for. They've thrown out some for suggestions. They seem to be a little bit onerous, but this will allow a person who wants to put $1,000 or $10,000 in an equity investment, a stock investment in a company, to do so. We'll talk about whether that's a good idea or not later on. Organized angels. There are economic development groups that have people and say, Well, these are angels here for companies to invest in, some of whom may be accredited investors, some who may not be accredited investors. There's good organized angels who have programs, policies, education for their group, and even entrepreneurs. And the best organized angels really are part of a larger group like the ACA, who shares best practices, allows people to get a lot of great education and not reinvent the wheel when you have to do some basic investment programs. We talked a little bit about JumpStart. Our members have invested over $48 million in the last 10 years. And trust me, that was a struggle. When the group first started, there were 10 people. It was hard to do a $100,000 investment. It really took about a year and a half before we could do an investment. Now we do $2 to $6 million or more a year in investments. And it's the strength of the companies coming in to see us, as well as the strength of our individual investors and their expertise. So we've invested in a lot of companies. We've had some good returns, but not as many as we'd like. We are the largest dollar angel investing group in the Mid-Atlantic region, with the highest dollar investments from Connecticut to Virginia, excluding the New York Angels. And we do syndicate with a lot of these other regional groups, but we're active investors because we have active investors around our table. Some groups have consultants or service providers sitting at the table. We don't do that. So let's talk about crowdfunding for a minute. All of you must have heard about some of the really interesting crowdfunding activity where Pebble, a specialized internet watch, had more than $10 million, I think, in orders, and it was a product launch via a crowdfunding platform, which essentially said the product launches are things that say, give me $100 now and I'll give you a 20% discount to the final product. Or go ahead and buy the entire product now and I'll ship it to you in 6 months. So a company is funding either their final development or the manufacturing of a product. And it's a great thing because you can identify that, yes, you have enough interest in this product and people are willing to buy it, and you're funding it somehow from this pre-sale. There's also donations or charities. You can today make a donation on one of these platforms. You don't have to be an accredited investor to support somebody's research in cancer, to set up a t-shirt shop and get a free t-shirt, to do a film. I've seen recently somebody's friend was doing a film and they sent the Kickstarter program to take a look at. So all of these different things are either donations or they are pre-product launches. So they're not an actual investment in the company. So the only equity that can be done on a crowdfunding basis is through accredited platforms, which have a lot of regulations in states because of state stock laws. And today, only AngelList, Seed Invest, and there's probably another 20 or so that are in this category. Only accredited investors can go on there. Only accredited investors can see the business plans, and they have the opportunity to invest on this platform. The general investor cannot do anything today. The interesting thing about crowdfunding is that, and even though JumpStart has invested in a crowdfunding platform, you have to ask yourself as an investor. So I put an investment in here. Some people think of it as a ticket to ride on a high-flying company, but you have no control. You're a small part of an investment. Who's actually driving the management? You haven't had a chance to take a look at the management. You've seen some summary. Maybe someone who's an investor said this is a good idea. It's a very tricky space, which will play out in the next few years. I'll also talk a little bit about this angel group landscape, because angel investing really is the engine of innovation, and all the new, you'll run across a slide that I use later on, in the last, say, 10 years or longer, all of the new jobs created in the economy, if you take out the angel investment or the small businesses, there are no jobs created. It becomes a negative number. And I think it's a very powerful piece of information for the economy. You don't think it's all driven from early stage. We all can name household names that were funded by angel investment. PayPal, Best Buy, Yahoo, WhatsApp, but not as much for WhatsApp, was mostly VC funded, the one that just made the big sale. Google, of course. And this is too small to see, but essentially, if you take out the job creation in startups, which is the blue line, then the net job creation absent the startups is generally a negative number in our economy. So startups are a powerful source. The other thing is, when we talk about angel investors, we also talk about early stage investment from venture capital. And we both love venture capital, and we have a love-hate relationship with venture capital because sometimes we work well together, and sometimes a venture firm will come in and do what's called a cram down on existing investors, and we don't do as well since our early stage investment is not valued. The venture firms, though, do not invest in seed and early stage companies to the degree that angels do. So startup seed, these are old numbers, but they're really about the same ballpark today. I didn't change the slide. Startup and seeds are funded to the tune of 20,000 investments by angel investors, and the VCs fund 300. For early stage, a little bit down the road, the angels fund 24,000, the VCs fund 900. And for expansion or later stage, angels will fund 11,000 companies and VCs 1,600. So if you're looking as an early stage company to get funding, the answer is unanimously angels, because that's where the source of your funding is going to be, and tends to be angel groups. This is just an expansion on that with the latest 2013 numbers. Angel investors invest almost as much as venture capital, which I think is a big surprise to most people. $25 billion versus $29 billion for venture. But they do 71,000 deals compared to less than 4,000. So certainly the VC deals are bigger, they're more powerful in terms of the expansion stage and growth stage, but in terms of the startup engine, they're just not the same space. So angels do 21% in seed, 41% in startup. VCs do 3% in seed, 29% early stage. So, and these numbers are extrapolated in terms of the number of angel investors for 300,000 versus venture capital firms which are active, which is almost like 460. So with all of those wonderful people out there who are angels, there's only a small subset that are in angel groups, even though angel groups are very, very powerful. Apparently there's about 8 million, almost 9 million US millionaires, informal investors, about 1 million, active angels, 265, 300,000, investors in angels group, 15,000. So it's like the 5% of the possible. So there's always interest in getting more angels active in this space. And I mentioned before that the number of angel groups has really expanded because people really want to have a portion of their assets in this high growth economy. And you can't get it, it's a private market, you cannot get it on the stock exchange. And so the only place that you can get it is by being there at the beginning in the creation of a lot of these companies. And that's the juncture where angel groups are. Angel groups are really embedded in a community which includes universities, other investors, venture funds, everything that pulls together a startup economy. And while we're talking about money all the time, the thing that's the most important is the knowledge and value and advice that an angel brings to a company. Because if you're just getting money, that doesn't mean anything. But if you're getting money that can give you an introduction to a possible partner, to a possible customer, someone who knows the market and can open doors for you, that's far more valuable than money alone. And angels join groups because they do not want to do all the work themselves. Okay? They've run enough companies, they've created enough things, they know how to do this, but they don't want to spend their entire life doing this. They don't retire to the golf course, though, either. So there's a variety of experiences that they have, and one of the things I like about our group, someone says they like it because the person sitting next to them is smarter than they are on either side, because someone knows something about optics, someone knows about advertising engines. Everyone has a specialty, and our members really want to know that. They're also diversifying their portfolio, because if you've invested in high-growth SaaS business B2B models, you want to move away from that a little bit. You may want to do some technology. You may want to do something that's slightly retail. You may want to do things in the medical space or the life science space. So that's part of the diversification of your own portfolio. So in our group, you get to pick the deals you like. We don't vote as a group. We don't have a fund. You go in with your own check, and you work on the due diligence team. And so we're very entrepreneurial friendly. We spend a lot of time actually drinking and networking with entrepreneurs. So because we are known as an early stage investor, actually a pre-revenue investor, so that is to our benefit.
Can you explain what you just said, that everybody comes with their own check and they do their own due diligence?
Sure. Well, what it does is they do their due diligence as a team, and we negotiate a term sheet with a company if we're going to invest as a group. But you invest with your own check under that same term sheet. So if we invest and say the total amount is $300,000, that would be made up by individual checks within the group. Okay, so there's no fund. There are some groups that are a fund where you've bought shares in an investment fund, and it may be just an angel investment fund, and they actually take a vote to see whether they're going to invest in that company versus another company. So the funds are already with the fund manager. I would say the average group does some investments in the $200,000 to $300,000 range, but it really depends. I mean, there's really big groups. There's groups in California that are 300 people, run in 6 chapters across San Diego. There are groups in the Midwest that have maybe 12 people. There are groups in Ohio that it's a fund that's 102 people. So all different kinds of makeups for the groups. But there are some ranges and there's some medians. Most groups do 6 to 7 deals a year. They invest maybe $1 million to $2 million, 200, 250 to a deal. Sort of averages run through the angel group stats that people report. This is hard to read from there, but essentially what angel groups are looking for is that, or any angel investor is you're looking for a high growth, inexpensive development and a fast exit, because you don't make money, nor does the entrepreneur make money until the company is sold. So the goal is to make it happen fast, grow fast, be very attractive, increase your value, and then be attracted to the person who's going to acquire you. So therefore, healthcare, which is listed here as in preference sector for angels, a lot of that healthcare is actually healthcare IT. Most groups do not do pharmaceuticals, they literally don't do drugs. They also used to do more medical devices than they do now, but the exit pattern for that has increased. Internet's hot, mobile and telecom's hot. I mean, this is that next wave where everything has to be mobile. So if it's not mobile, it's not going to grow well. So therefore, it's sort of software driven. But that doesn't mean that some of those technology improvements don't go into green energy. Our group likes clean energy, green energy. We'll like certain kinds of, we'll do financial services, especially financial services, IT. But hardware is hard to do. Hardware is expensive. So this is the preference area for angel groups. And every rule, I always say this, JumpStart has some rules. We don't invest internationally. We don't invest outside of our mid-Atlantic profile. We don't do retail. We violate every one of these. So when the right deal comes along with the right metrics, so we've invested in a retail subscription play, which is for babies. So if a baby signed up before it's born or when it's born, and there's a box that comes every month or 6 weeks with age-appropriate, sex-appropriate toys and gifts and products for babies. So we also invested in an automatic welding robot for pipelines. It sounds really, really good, sort of very futuristic, in Israel, because it was there, it was being done, and we were able to take advantages of the research grants that the Israeli government was making. So we violate lots of stuff, even though we say this is our core focus. I was talking about different sizes of groups. It says the average group is 43, with about 30% of the group having that, but some have much more and some have less. I'm just going to mention syndication. This is this issue of where angel groups band together, so instead of being able just to do $200,000 for a company, they can do up to $600,000 or larger for a deal. And this gets into too much detail a little bit in the financial area, but if you know the difference between convertible debt and priced rounds, angels prefer to price a round. That means say this is a valuation of the company versus saying I'll wait till the next round comes in and then I'll get a discount of 10 or 20% to that valuation to price my equity, to price my stock. We're getting a little much into the financial weeds there. And remember I talked about how even though angel investors invest in a lot of early stage companies, the deal flow is overwhelming. We actually invest in only 1 to 4 of the companies that apply to us. This is also the same kind of metric that venture funds do, because you're looking at a company, you're evaluating not just the product, the bright shiny object at the heart of the business, but can this management team execute? Can this management team make it happen? And that personal component, that management component is so critical. Now, we're also very forgiving because everyone has been an entrepreneur, of first-time entrepreneurs, people who can surround themselves with a good team, people who are coachable. But so much of this whole process is, can the management, can the team make it happen? So as we move down through it, it might be a great model, but it may not be able to be executed. It might be a great team, but they can't sell, and they can't figure out that they need people to sell their product. There's all sorts of variations of the due diligence. And now I sort of rushed through big pieces of angel investing. There's several angel investing groups here in New Jersey and in the Mid-Atlantic region. Glad to take any questions about this area or about accreditation or crowdfunding, whatever is on your mind. Sure.
If there is someone who has an idea or has actually started a startup, what is the first thing that they do if they're interested in following through in applying for some angel funds?
The question was if they have an idea or they've sort of started up a business, what do they do for angel funds to see about the process? First off, they have to have a little bit more than an idea, and they have to be able to sort of describe where they're going and sort of begin talking to a lot of other people to get some feedback about that, because they may have in their mind what's a great product, but it may be very niche oriented. They then they have to begin to describe what it is they have to do to get the product ready, how much it's going to cost, where that's going to happen, how long it's going to happen, and if everything works out well, what are they going to sell it for, and to get an idea of the shape of the business, because we generally don't invest in the idea or the product. We have to sort of figure out where does it fit. And so when they get to the point where they can do that or begin discussing it with people, that's the time they can contact angel groups. Because then they're going to have the answers. Because when you have a business, you have to be the expert in that space. You have to know, is there competition? What does it look like? You know, is your same product being sold for different prices? So you have to become the expert on that before you start talking on funding. But there's nothing wrong with talking to people and saying, you know, I've got this business, I'm starting it up, we're in this stage so far, but I'm not ready for funding, I just want to talk about ideas. You can do that too, get advice.
If somebody wants to join a group as an angel investor, is there a screening or a vetting process for someone that wants to be an investor? And if so, what is the process?
Okay. For JumpStart, it's relatively easy. Okay, we ask our members to provide a bio. We ask them, or prospective members, to provide a bio. Sometimes someone might know you and introduce you, but even then they may not know you well. We ask you to provide a bio. We invite you to a meeting as a prospective member and do a little small orientation about JumpStart. Because some people may or may not feel comfortable doing angel investing. So we give the prospective member a chance to take a look at what goes on and whether they feel comfortable with that. And then in our particular case, you do have to sign an application document which says all sorts of things like, I've never been convicted of this, or fraud, or all sorts of other kinds of disclaimers. And at the same time, too, we do ask our members to have to approve a background check, which we may or may not use. And the reason for that is, right now, I think it used to be a very closed society where people knew each other, and we were investing in early stage companies, but that's not the case. So we only have a person's word. I mean, if you have a bio on LinkedIn, that's more verification than saying that you are who you are. And so then, based on that, we have all groups have an annual fee to cover sort of their admin costs. So if you're interested, we invite you to join, and that's pretty straightforward for most angel groups in the area. And they're happy to talk to you and answer questions about their processes, where they meet, what they're focused on, what their kind of investments have been for the last year or so. So people are pretty open on that.
Is an angel association the first resort or the last resort? If you had an idea or a concept, would you go there first, or would you go to some other source of funding?
Well, generally, most people are bootstrapping quite a bit. Okay, so they're trying to bring it as far as they can themselves. There are other, depending on where you're coming from, like if you're in a university, you have a highly technical product, there's the availability of what's called SBIRs from the federal government. And angel investors love companies that have SBIRs, because what they do is they allow you to continue developing your technology or building a prototype. If you can get the grant, they are hard to get, okay? And there's all sorts of specialized rules of how you apply to the federal government for them. And I believe the small business associations in the state have some people who are trained to do that, or at least can send you to people who do that. And so you might be able to get an SBIR to help you develop your product, which is very good because it's non-dilutive capital. The government doesn't own your IP, and that is another source. Our state, New Jersey, does not have any early stage grants or any early stage funding right now for companies. I don't know if I answered the question. Sir?
Two questions. What is the typical exit time frame for investment? How long do you do
Too long these days. Originally, I would say 10 years ago, we were saying 3 to 5 years. And I think it's really gone from 5 to 7 years, maybe even a little longer, just because of the way the market is playing out. Now, sometimes all the stars can align and something can happen. We had a very excellent, totally serendipitous exit. 18 months, almost 5x the investment, okay? And part of that was smart negotiating, and part of that was total random chance, because a partner wanted to own the entire company. So it was great return, but you can't bet on it. But here's one of the things that's important for angel investors. Right now, there's a big focus on exits because no one wins until the exit happens. So from the day that people invest, the focus is on, are you doing the thing that's going to make this attractive for the possible exit partner? And that it's not just milestones that the company makes. You know, I finished this product or I released the product. What is the product that's right? Is it what you should be doing to make the milestone for the exit? So that's been a very active discussion in a lot of spaces.
If you join as an angel into an angel group, are you committing to the investments of that group? In other words, do you have personal choice to back out of an investment even if the group decides to invest in it?
In our group, you raise your hand to decide which investments you're going to go into. So we have 4 presentations at a monthly meeting. At the end of those presentations, or if you're not there, because you know people have other lives, they travel, they have other commitments. You raise your hand and say, "I'll go into the due diligence team." Now, when you raise your hand, it doesn't obligate you to invest in that deal, even if it's still a good deal for other people. You go into the due diligence. You're looking at the information about the company. You choose whether or not there's interest, and the group can say, "We looked at this. It seems to be very lukewarm. We're not excited about it. We're not going to be able to raise the amount needed, so we're done as a group." And other times you like the company and you want to fund it by yourself. That's fine too. So you get to make that choice. But we do ask our members to be at least active investors.
Let's say you have your own startup company, and before you do something formally, quote unquote, with a business plan, can you discuss informally with someone, explaining the basis of your startup, or it's an LLC, and, you know, without doing a formal business plan presentation?
Yes and no, okay? The people who you might talk to might be SCORE advisors, okay? Someone who has extra time. You might be somebody who you might know as an angel investor or an investor, and they might say, "This is interesting," or a friend who's a VC may give you some feedback. But I will tell you what works for me. If I have a one-pager on the company, I can be much more focused in giving you feedback than having a description, because I think generally in the beginning you're still trying to find your way. You're not sure where you're going, which is perfectly fine. You can say, I'm not sure which direction I should be going in or thinking about going in. So I think it helps when you talk to other people to have that one-pager.
The Angel Capital groups in New Jersey, I guess, are listed on the website.
Yes, if you go to angelcapitalassociation.org, you'll see in all different areas. And someone asked should you go to that site first? Even though you may be in New Jersey, it may be that there's an angel group that invests in your kind of business someplace else. Like there's some that are focused in energy, some that are focused, and that is also on the website for the ACA. They list them by state and sometimes what the area of interests are. But most angel groups are really geographic because you need to be close to a company that you're sort of mentoring and working with. So, did you get a feel for angel investing? Did you get a feel for sort of the interest that the angels have in early stage companies? And it was interesting when you had the question about if you have a business and you want to talk about this. Most of the people there have had their businesses, and they are very willing to give a lot of advice sometimes. But some of them are also very busy. It just depends on the individual.
Being involved in a crowdfunding platform. Could you talk about the platform you're involved with versus Kickstarter? Did you go to
Sure.
differences?
Angel List is probably the largest one that you may hear more about. We're invested in a company called, and I say we, which means a subset of JumpStart investors, are invested in a company called Seed Invest, which is located out of New York. And actually, Seed Invest just closed a round of $3 million with 3 venture funds. So we were in early, and so the value went up, and so that was a good thing. So Seed Invest is a classic platform which allows companies to And in fact, I think we're going to talk to one company who's actually put a product up, who's put a campaign up on there. It allows accredited investors only to go ahead and invest in this company on the platform. So maybe you're in Minnesota and you want to invest in a crowdfunding deal located on either the coast. This gives you access to it that you wouldn't necessarily have had access to. And that's part of the issue with crowdfunding platforms. It may give locations in the United States access to deals they would not have had access to. There's two other thoughts that go on too. Some people say sometimes maybe those that can't get funded locally are going to go on the crowdfunding platforms because that just gives them more visibility. But Seed Invest put their own campaign up on their own platform, which is a good thing to do. And there must be 20 or 30 platforms out there, maybe even more, in the accredited space right now. And I can't tell the difference between all of them. Some of them have fun. Some of them take a fee. Some of them just charge you something. Some of them charge the investor something. It all varies in terms of how they fund themselves. So I think somebody back there had a question.
Such early stage of investment, how do you determine what is the percentage of the investment in the company you are making?
It depends. If we're making an early stage investment, the question was, how do we determine the percentage? It is both art and science. People sort of say, how much of my company do I have to give up? And no angel wants to take 50% of your company. I mean, we only win, both of us, when we work together, and there's no interest in disincentivizing someone by saying, I have to take 70% of your company to get this investment. There's going to be that dilution farther down the line, but if you have 30% of a really big company, that's fine. But in the beginning, so generally if angels come in and they, depending upon the size of the investment that has to be made, they may take up around 30% of a company. And that's a board seat and working with the company also.
On your email, is that, I've never seen it, is that OM or ORG?
Oh, it's a mistake. It's missing the C.
That's why I'm here.
Good. I'll have to check. I'll have to correct that.
So it's COM.
You see, and the thing that people forget is JumpStart NJ, okay, which is there also too. Yeah. Glad to answer questions, and please contact me if you'd like to. Glad to do that. Okay, with that, thank you all.